morning, everybody. Thanks for joining us. My name is Conor O'Daly. I work on the Pengana distribution team. We're just having attendees filter through the acceptance register on Zoom at the moment, and we'll get started very shortly. I'm delighted to be joined by Bradley Amoils from Axiom Investors. This morning, we've got quite a bit to cover, so I'm going to move as quickly as I can through the introductions. Will be 30 to 40 minutes of presentations. Questions can be asked at any stage throughout the webinar, but we'll get to those towards the end. Usually we've got quite a few and we'll put them all together. So please ask questions as we move through the webinar on anything you'd like. Excuse me. A reminder that the Axiom funds in Australia offer both a hedged and an unhedged version, currency hedged and unhedged. And straight off the bat, we were delighted to receive recommended ratings from both Lonsec and Zenith for the investment strategy, which really underpins the long tenured and institutionalized process that Axiom bring to our funds here in Australia. This morning, we'll cover off a quick background on Axiom. Bradley's going to discuss the current environment, and in particular, we're going to dive into what structural growth looks like in the current environment. There's a couple of slides I'd really be keen for you to draw your attention to, which is around the 4Ds, which really are a key tenet to what we're seeing in the market at the moment and how we see investing evolve in a dynamic growth portfolio. So without any further ado, I'm going to hand over to Bradley. And a reminder, please do ask questions as we move through it, and we'll get to as many of those as we can at the end. Bradley, over to you.
Good morning, everyone. Welcome. So today I'm going to spend around 30-40 minutes updating you both on Axiom and on the Pengana Axiom International Ethical Fund. A couple broad things to begin with as a point of departure. So our firm, Axiom Investors, is a very client-orientated, focused and aligned boutique investment shop. We've been around since 1998, and importantly, that really leaves you in the stewardship of very seasoned, tenured investment professionals. And clearly, we're in a world where things are changing rapidly, where markets are not trending in the direction that they have for the folks who've been doing this for shorter periods. And that really is critical and I believe helpful for clients like you folks. So we have a defined philosophy. It's very bottom up. It's very fundamental. And it has proven itself over the course of multiple decades to deliver 200 to 400 basis points of outperformance net of fees. And really at the heart of that are the people. So my partner, Andrew, and myself have been together for 20 plus years. The team in general has 30 years of experience and more. And even our analyst team have a decade or so of experience. And overlaid on that is a very collegial environment where we're all in one location, where we're very client focused. We're very focused on only looking at one type of stock, this dynamic growth type of stock. And importantly, we have an awful lot of skin in the game and are very significantly co-invested with clients like yourselves. Here a snapshot of Andrew and myself, reiterating what I just mentioned. Delving in for a couple minutes into our philosophy. So it's very much an alpha-driven philosophy that is bottom-up and that over time has been very successful in compounding very attractive returns for clients, notwithstanding the market conditions. And there are three broad tenets to what we do. The largest one, which accounts for 60% of the philosophy, the approach, is really this very holistic embracement of positive change. And this is not the financial results that we saw reported today. These are very forward-looking, real-time operating characteristics, be they market share changes, price increases, additions in terms of employees and a sales force. And they're also very holistic. Andrew and I both have a very empirical science background. He did molecular biology. I studied laboratory science before going to business school. And that really means that we test a hypothesis we're open to the data. We're very open to changing our view. And that means that it's a very real-time, holistic implementation of this approach that includes both macro, micro, ESG, obviously integral to an ethical fund that we have here at Pengana, and is the lion's share of what we do. Overlaid on that is the balance of 40%, which really is a synthesis, an aggregation of both the sustainability, the moats around the performance tailwinds, and the financial characteristics of these businesses, as well as some cross-check and calibration with regard to what we're paying for these enterprises, really cross-checking that we're not too late, and confirming the longevity of the thesis. So this combination, positive change, sustainability, and valuation, is intrinsic to what we do with Axiom. In terms of the ethical fund in particular, there are a dozen screens, which are pretty self-explanatory, that exclude obviously certain sectors, certain industries, and certain categories of stocks. For us, this is just an overlay on something that we've done for a couple decades. It does mean that there are some guardrails with regard to, us owning things like energy, mining, which in terms of performance have sadly, been detractors in the short term. But I'm going to chat to you a little later about how constructive we are on the 4Ds and growth in general. And really, these dozen criteria are not a problem in terms of us executing and delivering on the task of providing alpha for you folks. In addition, we're very active. We choose to engage with the companies. We very actively vote proxies, and we're very acutely transparent about this. Importantly for us, really what's key in terms of ESG, moving to this next slide, is not really the point of departure, but it's the direction and magnitude of travel. So if you look at this fund, obviously we all subscribe to things like MSCI, then rank all the 55 odd stocks that we own at the moment, score them and compare them to the universe and compare them to how they ranked before. But importantly for us, ESG is both a risk control, obviously with those criteria I just showed you, but critically a performance and alpha generator. And what we found, and in some significant studies, is if you can be at the driver of environmental, particularly social, which tend to occur more quickly, and governance changes, those are very impactful on creating alpha, on adding incremental performance to how those securities track and how they compare to the benchmark. And if you look at this portfolio, it has a AAA ranking by MSCI, which is obviously very backward looking. So we're much more focused on change and looking at that algorithm of the 55 odd stocks that we own. 20 of those stocks have had upgrades in terms of the ESG criteria over the last year. And that, we believe, is really critical and most importantly helpful in creating outperformance for securities moving forward. In terms of the markets, clearly markets have been difficult. Pretty much every publicly traded asset class, be it equities, be it fixed income, have had significant drawdowns year to date. The only outlier is the commodity markets. And then in particular for this implementation, we're clearly growth investors. Dynamism, dynamic growth is in our wheelhouse and where we add value. And in an environment such as year to date, which you can see on the screen, we've unfortunately had a rotational period where macro and policy and geopolitical events and events that really comprise unpredictable tail risk type factors have caused a rotation, and particularly our growth stocks have suffered disproportionately. So looking here, you can see the MSCI All Country World Growth down 25% compared to the broader, compared to the value index, which is only down 8%, and the broad index somewhere in between. So net, 15, 17% downside capture, unfortunately, incrementally for growth stocks. But that really, for us, is an attractive point of departure, because we, having done this for a long period, having navigated many markets, these tend to be really unique opportunity moments where our strategy, and in particular growth investing, which I'm going to elaborate in a moment, which is becoming incrementally more scarce, really are in there in the sweet spot for a very dynamic and very sharp rebounds. Looking at the macro around the world, clearly we're in a time of extreme uncertainty. We spend a lot of time tracking tens and dozens of data points per country, per region, per day, and then aggregating them. These are our macro data on a weekly basis. You can see we bucket them into 4 broad categories: growth, inflation, and balance sheet. And here I'm showing the macro data for growth. Up until a week or two ago, you can see 170, nearly 180 data points in the bottom row. You can see how many we capture. And clearly you can see that global growth, as we color it between bright green being positive and red being negative, is clearly decelerating. And amongst many of the uncertainties that we have around the world and that are being digested by markets, which are clearly very forward-looking, is this aspect that growth is moving from a very positive green-colored set of data towards a set of data that we actually ranked this last week, which I don't show in this presentation, is actually 0 minus, a marginally negative set of data across the 120 odd countries around the world. You can see us bucketing them in terms of geographies as well. Most importantly, North America and Asia, which includes China, as well as Europe to some degree, are clearly slowing. So that's sort of one of the few takeaways and certainties that we can have around the current macro backdrop. In addition to that, in terms of inflation, and we rank inflation as higher as negative. So clearly here you can see a ubiquitous negative picture for inflation, with 60 plus data points being negative, a pattern that has been evident for the entire year and maybe troughing with sort of a peak towards the end of April, where you can see the brightest aggregation of positive, namely high inflation upside data, which obviously we score with a minus. And then finally, the balance sheet. Here you can see balance sheets are pretty mixed. They've gone from being marginally positive to being pretty neutral ex North America, but really not front and center for investors right now. Something that is clearly critical as to whether you're an importer or an exporter of commodities. Just wrapping up in our macro forecasts, we really are bottom up. We focus on the businesses, their fundamentals, but clearly one of the key drivers over the last couple of decades has been the dollar, and the dollar has pretty much been in a trading range. Here I show you 2 decades out of the dollar's movement, and what you can see here is the dollar sort of flirted with breaking out of a multi-year trading range. This is the DXY, around about 104. It has actually fallen back, and that has some important implications for particularly US domiciled companies. But in the end, it really sort of emphasizes the dollar continues to be in a very long trading range. Nothing very different, notwithstanding all the rate and policy and geopolitical changes that have occurred over the last few months. moving on to a scorecard of where we are in terms of very much backward looking, but these are the S&P earnings results for the first quarter. A ton of information here, but I would really draw your attention to the far right, where you can clearly see in green are the companies that are above expectations. Yellow are those that are pretty much in line. And most importantly, those that are falling below. Enormous amount of info here, but really stepping back, what you can clearly see is that the consumer discretionary companies, and this was even prior to the shock surprises from Target, Walmart, and some of the discount retailers last Thursday, Friday in the US, are beginning to disappoint. And you can see, meaningful around about 40% earnings downside surprise, and that contrasts with the overall S&P, which is towards the middle of the chart on the fifth bar, where we continue to see about 80% positive surprise for earnings. But really looking a little deeper in terms of markets, as I mentioned earlier, are very forward-looking. We're clearly looking 6 months, 12 months ahead. So for right now, we're seeing that on the left, the energy, industrials, and material stocks. The blue is the change more recently, and the gray is a sort of a month behind, continuing to surprise pretty dramatically to the upside. But obviously with 100% upside surprise for energy and nearly 40% for energy, nearly 20% for materials, the peak is near. And importantly for us, taking a look at where our portfolio is really located in things like information technology and healthcare, you can see obviously not the magnitude of surprise, but importantly, notwithstanding what I mentioned earlier, a clear deceleration in global growth approaching. The technology companies continue to hold their own, unlike things like the financial companies, which are disappointing dramatically. And that really brings me to what lies next. And that's obviously critical for any investor. It's critical for us. We're very bottom up, but no company operates in a vacuum. And for us, as I mentioned on the earlier slides, our approach is to find dynamic growth, to find companies that are clearly seated in that spectrum of providing 60% positive surprise, 20% being incremental sustainability to the surprise at a moderate valuation. And sadly, the problem for the world we live in right now, as driven by what we call the 4Ds, which are demographics, debt, deglobalization, and disruptive technologies, we are in a difficult spot for the market in general. Fortunately, we're in a way better spot for our type of growth stocks. So if we break the 4Ds into two broad categories, the first two, demographics and debt, these two are acting as a giant speed brake, as an inhibitor for global growth. Demographics, not as a surprise to anybody, global populations are slowing in all continents ex Africa, and that is resulting in a rapidly aging population. China, even the engine of global growth for the last 2 decades, only had a birth rate of about 9 million folks, compared to a peak of 12 to 14. So clearly, demographics are a significant headwind for the globe and are providing a dearth of dynamism and growth. In addition, debt. We're all focused day by day, press articulates every moment about rates and debts to GDP. Clearly, the global debt burden is high. Debt is both onerous for central governments, for central banks, and to a great increasing degree for personal balance sheets. And that really means that that acts as well as a brake, as a deterrent, as a decelerant on global growth. As debt is high, rate uncertainty is very high, and the probability that debt is going to cost more is, something that is not very hard to predict and synthesize as a significant deterrent to growth. On the other hand, as we move to the latter two Ds, deglobalization and disruption, these two are really the opportunity set. They are square and in the gun sights of many of the stocks that we own. And deglobalization has been or globalization rather, has been a multi-decade, basically post-World War II environment that we have all lived with. However, the combination of trade wars, COVID, and now a world where just in time clearly is not good enough and has to be replaced by just in case, really means that many companies are reassessing their supply chain, reassessing their reliance on distant workforces, distant resources. And that really is driving capital spending towards newer technologies, towards newer areas, and is becoming very disruptive and, in fact, very supportive of many of the stocks in our portfolio. So local supply chain is driving production of EVs, be it Tesla having local production, not only in California, but now in Austin, Texas. In addition, in Europe, in Berlin, batteries being outsourced from China and Korea to Sweden with the Northvolt type of project, or even Apple, the global leader in assembly and consumer goods, reconsidering their 90% reliance on China for assembling their Macs, PCs, and obviously iPhones. So clearly, we're having a dramatic pullback in deglobalization. Even platform companies like Airbnb are moving away from growth markets like China. And that for us provides a significant tailwind, particularly for some of our companies that are very focused on this incremental capex for developing semiconductor fabs in Phoenix, Arizona, or Austin, Texas, such as ASM Lithography. And those are acting as incremental dynamism drivers for our specific type of stocks. And then finally, and probably holistically most important, is innovation is global. Innovation is here to stay, and innovation is asymptotically, incrementally getting steeper, barriers are getting higher, and adoption of technologies is getting even faster. So that really adds rocket fuel to the disruption and dramatic disproportional growth for companies like in the technology and healthcare space that we own, that really benefit from innovation, notwithstanding a world where debt and demographics are clearly slowing growth, as well as obviously monetary and fiscal tightening. I'm going to pause here and scroll forward to a couple of our holdings and hand it over for some discussion and questions.
Thanks for that, Bradley. Great run through of the portfolio, what's going on in markets. So we do have quite a lot of questions, and please do continue to ask them as you think about them, and we'll move through the initial few now. So first question is based around the team, actually. So obviously there's a great long-term experience, but how do you think about key person risk within the team? And I guess that really refers mostly towards yourself and Andrew.
Sure, Connor, great question. So I think one of the good things with Axiom is that you're buying a very long tenured team. Unlike many organizations, big companies, both Andrew and I were at large organizations that tend to be owned by financial conglomerates such as PIMCO or a big bank. Those companies really don't have the ability to both attract and retain staff that a boutique like Axiom does. So we're a partnership. We've extended the partnership across the majority of our senior analysts, obviously across all of the portfolio management, across various operational elements within the business. And that really allows us to broadly, most importantly, attract, and then certainly for people like myself, to retain and to basically scale and align the economics in a way that we are very much in the same bucket as our clients. And to put it in a synopsis, the lion's share of most of the key Axiom personnel are invested in our own products.
Great, thanks for that. So moving, I get actually sticking a bit more on maybe philosophy and around the 4D. So we've got a question: is the 4D something that's ingrained in the process? It's been there, since inception, or is that more a market globalization theme, macro theme that really has been looked at over the last few years? So a more recent addition to the portfolio.
Sure. So our process really focuses on positive change, sustainability at a reasonable valuation, with the majority of that 60% focused on positive change. And this is implemented in a very holistic fashion. I keep emphasizing that. It's really not backward looking. It looks at real-time fundamentals, be they new products, introduction, market share gains, pricing changes, and macro tailwinds that either are helpful or a hindrance to those stocks. And we are not anchored. We'll change our view with regard to discrete companies, countries as a result of that. The 4Ds is more of a thematic overlay that really we have used and we are articulating as something that we believe is here to stay. We are clearly in a world where those 4Ds are pretty stagnant. They're not going to change over the course of the next few years. And they provide a landscape that really helps certain countries and, most importantly, helps certain enterprises, particularly those that are disruptive and where they're not incumbent to poor demographics and those debt burdens. And that broadly refers to, if you take a look at our top 20 holdings that I have on the screen, many of our technology, healthcare, and innovative consumer companies that offer very high returns and great financial runway for their businesses, notwithstanding, slowing growth and potentially a higher and adverse rate environment.
Right, and I think that flows through quite nicely to just to ask a couple of portfolio questions. So we've got two that are quite similar, but I think they're different answers, so I'm going to ask them separately. First relates to the chart you posted that looked at Q1 earnings, where, we can see really clearly that businesses are posting or beating their earnings expectations compared to what the market expected. So the question is this an environment that we think is really as negative as it seems, or have we just convinced ourselves that it's a more negative environment than what's really actually happening with the businesses that you're invested in and across the market?
Sure, that's obviously the $64 question, and the one that the market is grappling with day to day. I think the key thing here, and having done this for many decades, is markets are clearly very forward-looking. The markets are not looking towards Memorial Day here in the US in the beginning of summer. They're very much looking forward to at least September, and where growth, inflation, and of paramount importance, earnings will be by then. So if you look at the left of the chart, clearly the dramatic outperformance of in industrials, consumer staples to some degree, IT, and healthcare are reflected in valuations. Obviously, the more cyclical stocks are assigning very low PEs on cyclical highs. Conversely, in the consumer staples space, what would be considered as more robust, and there's going to be some debate about this because of earnings and costs, are being assigned very high PE multiples and considered very durable. On the other hand, on the far right, the consumer, as we saw last week, is clearly under duress because of two key things, really: energy prices, utility prices, and to some degree a lack of stimulus and the basket of inflation in general. So a very hard question to answer. For us, we are very deep in the weeds in the data, and our businesses, our technology businesses, are continuing to surprise, notwithstanding, the baby being thrown out with the bathwater in a stock like ASML, where multiples are significantly compressing, even though the company is guiding up and surprising, notwithstanding some speed bumps because of bottlenecks. But that really is the $64 question, the one that both us, Federal Reserve, and every market participant is waiting to see. And we are clearly very data dependent, but I would leave you with that one of the few certainties we have is that growth is going to decelerate. And then that the second derivative of that is going to mean high prices fix high prices, and inflation is going to come down. The real big question is, where does it peak, or has it peaked? And I'm not going to make a prediction there, but it may well have. But more importantly, what is the new normal in terms of the 6 to 12 month number? Is inflation, 6 to 8 or 3 to 5? And those really are critical to investors' appetite for different asset classes and different types of stocks.
Great. And so following on from that question, and I'm going to add to this because I know your process maybe a bit better than some others do. And it's something that I've wondered myself on top of a couple of people who've asked questions around this. But within the way you're managing portfolios, so you've got lots of data, lots of indicators, looking for dynamic growth in places that maybe other people aren't looking for it. How at the moment are you finding, balancing sentiment, market momentum within those indicators on one side, and then on the other side, like a company's actual ability to grow earnings over time? Like, is that trickier at the moment or in more volatile markets?
Sure. I would bucket it in two categories. Clearly, the more cyclical companies, those that are geared to an accelerating economy, are beginning to peak out, or at least the market is discounting those earnings at a lower multiple. So that's really meant that we have reduced cyclicality in the portfolio. We've sold some of the more cyclical technology companies, and we've sold, obviously, to some degree, some of the cyclical consumer-based companies. On the other hand, the market has been rewarding companies that have stable and reliable, long-tailed earnings growth, particularly in the healthcare and the some of the areas that are benefiting from some of the bottlenecks and the geopolitical factors. So we've tweaked some of the more cyclical aspects of the portfolio. We've added to some degree some more stable names that have tailwinds from high energy prices, such as a Costco retailing, where people buy gas more and return to the discount warehouses, and some discrete companies like Nutrien that are benefiting from the Ukraine war because they're in the right spot for fertilizers, be it nat gas and potash. But overall, we haven't made a lot of changes. We really are fortunate that the lion's share of our portfolio companies, continue to to step over the bar, continue to provide earnings surprise and favorable guidance, notwithstanding an environment where growth is slowing.
Great. So a few questions around, so obviously the portfolio has tailed off quite a bit since the beginning of the year. I mean, is there any names in particular that have detracted more so than others that maybe have been a cause for concern, and maybe if you could talk about whether you've kept them in the portfolio or have exited those positions?
Sure. So I mentioned earlier ASML, continues to be a leading fabricator of cutting edge deep UV steppers that are intrinsic to making semiconductors, particularly at the smaller, lower nanometer size. And those are, continue to do disproportionately well, and are areas that, notwithstanding that they've hurt the portfolio, are stocks that we have stuck with to some degree. We've modified position size, but they are, top holdings. In addition, I would add Estee Lauder, Tesla, and to some degree Alphabet are also top 10 holdings, both active and absolute, that we remain with high conviction around. They obviously are impeded by shutdowns in China, specifically Estee Lauder and Tesla, where they either have customers or production facilities that are in the eye of that storm, but where the longer term, 2 to 4 quarters out, cadence and growth opportunity look very, very attractive, and where we have remained steadfast with regard to those names. There are a couple in the consumer space, some of the lower end consumer companies. I would say like American Eagle, which manufactures lower end jeans and teen apparel, where they're very acutely sensitive to a more inflation impeded customer. We've moved away from, and those that would fall in the category of some names where we have moved on from and exited. Another one I would say is Align, which is a orthopedic dental. It's effectively teeth alignment plastic cases that one subscribes to. Been a huge beneficiary of COVID, where their businesses are slowing as people's budgets are more restrained, and it's, broadly speaking, the consumer changing their spending habits. And so those would be areas that we've made some changes and recalibrated and repositioned the portfolios.
Okay, great. Okay, the final question, I think, unless any more come through, and it's a great question and front of minds for a lot of us at the moment. So we had a slide that talks about investing ahead of ESG changes, and you've obviously had ESG integrated into the portfolio and the investment process since inception, so I've been doing it for a long period of time. But maybe could you talk a little bit more around what exactly you mean by getting ahead of the curve around ESG investing?
Sure, Connor, great question. So one of the issues with being a steward of ESG and an ethical fund is pretty much all of the ESG criteria, Sustainalytics, Morgan's MSCI, Rep Risk. The problem with those scores, where they score a company a AAA or a single B, are really that those are past performance and past behavior. And for us, what our focus, both in ESG and in operational financial metrics, have shown is that the change is paramount. Nothing stands still. If we stand still, we're moving backwards. So the problem with those scores is they're all backward looking. And our group, particularly our director of research, have done some studies that have shown that companies, particularly in the social and governance categories of environmental, social, and governance, those two that actually tend to be more dynamic, they tend to change more quickly. Clearly, the environment, as we're all aware, is multi-decades of oversight and marginal incremental change, and hopefully all in the right direction, but really sort of at a snail's pace, tend not to be rewarded in the shorter and medium term by stock price performance. On the other hand, social changes, particularly here in North America, regarding human capital, things like data security, privacy, generally policies, and things that the enterprises can change by their actions and by them embracing what investors are guiding them to, and things that we actively engage with, companies like ServiceNow, where we've reached out, some other smaller companies where they just haven't had policies in place because the businesses have grown faster than their policies have been able to keep up with, are areas that have disproportionate impact and result in eventually the rating agencies, but more immediately investors embracing this incremental transparency, disclosure, and concerns really are very impactful in re-rating stocks. And then finally, on the governance side, I would really say that governance, particularly for the entire Pacific area, and particularly Southeast Asia, China, are areas where there's been a lack of focus, but where any change, any incremental improvement in alignment, any incremental improvement in practices around ethics and boards and alignment around investor concerns are also rewarded very quickly. So for us, we have a very holistic approach to ESG. We're pragmatic. We want to outline and amplify and discuss with companies. And we have hundreds of data points over each quarter that in our Axware rating tool and ranking tool address these categories, and we are very proactive. And that we believe has been very helpful. Our view is really not to use ESG as a threat to divest, or other than the 12 categories for this ethical fund, a wall, a barrier to avoid, but really an area to both monitor risk, but most importantly, be proactive in looking for incremental and positive advancement.
Great. Well said. Bradley, thank you so much for joining us this morning, your evening, afternoon. We're delighted that we've got our investors with us this morning. Hopefully you've got something out of this morning's webinar. If there are more questions you'd like to ask Bradley or anyone at the Pengana team, please do feel free to contact us. You'll pick up our contact details at pengana.com if you're unsure who that is. This webinar has been recorded, so if you'd like to share it with friends and colleagues, it should be available on our website a little later this afternoon. So from me and Bradley and the rest of the Pengana and Axiom team, thank you very much.